Morning, students.
Good morning, sir.
Morning, sir.
So today we'll start with question number 19. Question 19.
But today you don't have an exotic background.
Yeah, today I'm running out of screens. All the screens are already displayed.
Running out of places.
Yes.
World tour is completed.
Huh?
World tour is completed, sir.
Yes, yes. Actually, CMA inter students now they used to ask me every day, sir, which location is this? I used to tell them. One day I used to tell them I'm at London Bridge, and one day I'm at the beach. So like that, they used to enjoy. Every day they used to ask me, so today where you are? So after all the trips, I have now come back home. So let us start with question number 19. Company has produced 1,500 units. So actual production is 1,500 units against a budgeted quantity of 2,000 units. Actual sales were 1,300 units. Out of 1,500 produced, 1,300 have been sold. So we have a closing stock of 200 units. Closing stock of 200 units. Company's policy is to value the stocks at standard absorption cost. Other data is given to you. Direct material 100 per unit, direct labor 100 per unit at normal efficiency. Variable overheads and fixed overheads are given. Now, this will be assumed to be manufacturing overheads because they have given selling overheads separately. Variable selling overheads and budgeted fixed selling overheads they have given separately. Actual fixed selling overheads are given separately, 25,000. Selling price is 400 rupees per unit. There was no opening stock. First is present the profitability statement under absorption costing system as good as traditional costing. Second is assuming actual labor was 25% below normal efficiency and 100 units of the production had to be scrapped off after complete manufacture. Compute the actual profit or loss. The first is on absorption costing basis. Then we calculate the actual profit or loss and then reconciliation of the two profits. So let us start with absorption costing. Statement of profit, or you can say a statement showing profit. Bracket you write absorption costing. Starting with sales. We have actually sold 1,300 units and the selling price is 400 rupees. So 1,300 into 400, 5,20,000. Less absorption cost. Opening stock is not there. This is absorption stock of cost of production. Opening stock is not there. So right, opening stock nil inside, right? To this we add cost of production. We have actually produced 1,500 units into material cost 100 rupees, labor cost 100 rupees, variable overheads 50 rupees, and the fixed overheads are given as 1 lakh at budgeted capacity. Budgeted capacity is 2,000 units. You see the problem? They have given fixed overheads at budgeted capacity.
So labor cost is 133.33
No, it is
because they
100
said
rupees.
yeah, no sir, they said produce 1,500 against the budget of 2,000, which means the labor cost 100 rupees per unit at normal efficiency, which means they were inefficient in terms of producing the units.
No, they were inefficient. That is for the second part of the question, not for the first part.
But still the production against 2,000 budgets, right? The budgeted under normal efficiency is 100 per unit for 2,000 units produced.
Yeah.
So that means you get 100 into 2,000 divided by 15.
No.
Sorry, 1,500.
That is not for absorption cost. That we will do for that calculation. We will do only for the second part of the question. That is for calculating actual profit or loss. That inefficiency that you are talking about, normal 25% below normal efficiency, that will calculate
Okay.
for the actual calculation of profit or loss. Absorption is taking place at 100 rupees only for 1,500 units.
Why, sir? Because we're not taking the actual cost here. Why are we not taking the actual cost?
Absorption costing means what? Absorption costing, you don't go on the basis of actual costing. Absorption costing, for example, overheads and any other expenses are taken on an arbitrary basis. It is not an actual basis. That is why we introduced activity-based costing, no? Because that was one of
Okay.
the deficiencies of absorption costing. Absorption costing, for example, overheads, you must have done in inter-CME.
Yes.
Overheads, what we do is we classify, we apportion the overheads on some arbitrary basis, on the basis of number of units or on the basis of floor space index, like that. So that is actually absorption means that it is allocated. It is allocation or absorption or you can say apportionment.
Yes.
The actual figures are something different. So here we are going on the basis of absorption costing. That is why I underline that absorption costing. So all the inefficiency, etc., will calculate in the second part. So
Okay.
then we do the reconciliation. So actually it was like this absorption we have done like this. So, we had over recovery and under recovery like that. So that will come
Yes.
in the reconciliation part.
Okay.
So fixed overheads are 1 lakh on the budgeted capacity of 2,000 units. So 1 lakh divided by 2,000. So this will come to 50 rupees per unit. So plus 50 here. So 300 into 1,500 is 4 lakh 50. minus the closing stock. Closing stock we are having
200 units.
200 units, valued at cost 300. That is 60,000. 3,90,000. 520 minus 3,90,000. 1,30,000. Less under absorption of overheads. $500 units. Because budgeted figure was 2,000 and we have calculated on 1,500. So 500 units at the rate of 50 rupees per unit. So that will be 25,000. So gross profit is 1,05,000. Absorption costing statement you have done in inter-CMA also. Less selling overheads. Variable 26,000. Fixed overheads, actual fixed overheads 25,000. $51,000. Net profit. $54,000. This is your net profit as per absorption costing. Now we'll find out the actual profit or loss and then we'll do the reconciliation. Statement showing actual profit or loss. Now this will be prepared on the basis of your cost sheet. Starting with direct cost. Direct materials. $1,500 into 100. 1,50,000. Direct labor. Now, direct labor it will be fined 1,500 into 100 rupees. But they have said that actual labor was 25% below normal efficiency. So I will have to divide this by 75%. 25% below normal efficiency. That means it is not 100% figure, it is 25% inefficiency. So if the labor is inefficient, the cost will increase. So that will give me figure of 2 lakhs. Prime cost 3,50,000. Indirect cost variable overheads, variable manufacturing overheads. 1,500 into 50. 75,000. Fixed factory overheads, fixed manufacturing overheads on the basis of budgeted figures. 1 lakh, right in bracket actual. In the earlier statement, we took on the basis of absorption. Here we are taking the actual figures. Works cost. $5,25,000. Sorry, I will not call this as works cost. Less closing stock. Then we will get the cost of production. Closing stock. Now what is going to happen is, closing stock we are having 200 units. But they have said that 100 units of production had to be scrapped. That means after the goods were produced, they were scrapped. That means out of closing stock. Out of closing stock. So closing stock is 200 units. Out of that, 100 units are scrapped. So the balance will be valued at 300. So 100 into 300, that is 30,000. And I'll have cost of production, or you can say cost of goods sold. 4,95,000. So all this is on actual basis. Add selling overheads. Variable, it is 26,000. Fixed actual is 25,000. Total 51. Total cost 5,46,000. Profit, balancing figure. Sales is known to me. 1,300 units at 50 rupees. Sorry, at 400 rupees. 5,20,000. So actually there is a loss of 26,000. Loss of 26,000. Okay. Now, next part is we have done the calculation of profit as per the absorption method. We have done calculation of actual profit. We have resulted in an actual loss actually. Now this figure of 54,000 and this figure of 26,000 has to be reconciled. So we'll prepare statement of reconciliation. Statement of reconciliation. I'll start with the profit as per absorption costing. Is 54,000 less additional cost on account of inefficiency of labor. Labor inefficiency. How much is that? If you see here in the first statement, labor cost was 100 rupees for 1,500 units. So 1,500 into 100. So I have taken here 1,50,000 as labor cost. No? I'm just talking about labor cost. Now, actually, this amount is 25% below normal efficiency. So this 1,50,000 actual figure is 1,50,000 divided by 75%. So that comes to 2 lakhs. Okay, as labor cost. So what is the increase over here? The increase is for 50,000. Okay, so additional labor cost on account of inefficiency is 50,000. Then value of scrapped units. There we had taken closing stock as 200 units at 300 rupees per unit. Closing stock I had taken 200 at 300 per unit. But actually, out of that, 100 units are lost, 100 units are scrapped. So the cost of that scrapped units 100 units at 300 rupees per unit. That is 30,000. 30 minus 54. It's 26,000 loss. Okay. So one thing that you notice over here is that when you're doing absorption costing statement, you must have done this in the earlier case also, that is in inter CMA. After you show the cost, at the end you take the over absorption or under absorption and adjust that figure only of manufacturing overheads, not of selling overheads or anything else. Manufacturing overheads. If it is over absorption, you add. If it is under absorption, you less. Okay. Let us come to question number 20. Vimal Fabrics manufactures quality napkins at its unit in Khed. The unit has a capacity of 60,000 napkins per month. Present monthly production for April is 40,000 napkins. Present production 40,000. Cost incurred for the actual capacity is 60,000. Cost incurred for production is 6 rupees per unit. For direct material, direct labor is 2 rupees per unit. 75% of this is fixed. It is 1.5 fixed. 0.5. So variable direct labor is not 100% variable. Manufacturing overhead is 4 rupees per unit, 25% variable. So fixed is 3 rupees, variable is 1 rupee. Marketing cost per unit is 7 rupees, 5 rupees is variable. Marketing costs include distribution cost and customer service cost. Present selling price is 22.5. Due to a strike at its existing napkin supplier, a hotel group has offered to buy 10,000 napkins from Vimal Fabrics at 11 rupees per napkin for the month of June. No further sales to the hotel are anticipated. Fixed manufacturing costs and marketing costs are tied to the hotel. Tied to the 60,000 napkins. That means the fixed manufacturing cost and the marketing costs are based on 60,000 napkins. Acceptance of the special order is not expected to affect the selling price to regular customers. No marketing cost involved in the special order. Prepare budgeted income statement for the month of June. Actual income statement under absorption costing for April. Also state whether Vimal Fabrics should accept the special order from the hotel or not. So first, let us calculate budgeted income statement for the month of June. Particulars in 3 columns. What are the 3 columns? 3 columns will be 3 columns will be one for 40,000 units, one for 10,000 units for the additional offer that has been made, and one for total. So budgeted income statement. This is question number. Budgeted income statement. For the month of June. Sorry. This is for 40,000 units. It's for 10,000 units. This is total. Starting with first selling price per unit. For 40,000 units, customer, you are selling at 22.5 per unit. Selling price per unit. $22.5 per unit. And for that additional order of 10,000 units offered by the hotel group, we are selling at 11 rupees per unit. Less variable cost per unit. Variable cost per unit. Variable cost per unit. What is the variable cost per unit now? This is variable cost 0.5 plus this one. What else? This 6 rupees material cost. So 7.5, 7.5 and this 5 rupees, 12.5. Correct now? 12.5. So variable cost per unit is 12.5. For the additional 10,000 units, this 5 rupees we are not going to incur because there is no marketing cost. We are directly approached by the hotel and the order of 10,000 units is placed. So that 5 rupees variable cost is marketing cost is not going to be incurred. Okay, so it will be 6 rupees plus 1 plus 0.5, 7.5. For the 10,000 units, the variable cost will be 7.5. Contribution per unit. 10 rupees and 3.5. Total contribution multiplied by the number of units. Total contribution 10 into 40,000 is 4 lakhs. 3.5 into 10,000 is 35,000. So total is 4 lakh 35. Less the fixed cost. Okay, now see, importance of this statement. Fixed cost we are having now, this 1.5, this 3, 4.5, 4.5 and 2 rupees over here, 2 rupees over here, 6.5. Now this 6.5, look at this statement. Fixed manufacturing cost and marketing cost are tied to 60,000 napkins. That means they are based on 60,000 napkins. So the per unit figures are calculated on 60,000 napkins, and that cost is not going to remain that cost is going to remain the same irrespective of how many units are producing. Because fixed cost, that is the nature of fixed cost. Fixed cost remains same at all levels of production. So 60,000 units, 60,000 units at 6.5 per unit. Three lakh 90,000. Net profit is 45,000. This is for the month of June. Okay. Now that is the first part. Second part, they are asking us actual income statement under absorption costing method for the month of April. Now in April, we did not have that special order. So we had only 40,000 units. Okay. In June, we had this special order. So let us now prepare the income statement, actual income statement for the month of April, 40,000 units. Total cost in CPU, cost per unit. Sales is 22.5. 22.5 into 42,000, 40,000. That is 9 lakhs. Less cost of production. How much will be the cost of production? Direct material, 6 rupees. Direct labor, 2 rupees, 8. 2 and 6 is 8. 8 and 4, 12 rupees. 12 into 40,000 is 4 lakh 80. Gross profit. $4,20,000. Less marketing cost. Marketing cost is 7 rupees per unit. 7 into 4 is 2,80,000. $420 minus 280 is 140. 3.5. Less. Less or add. Absorption of overheads. Overheads are calculated on the basis of 60,000 units, but we are calculating actual on the basis of 40,000 units. So there is under absorption of fixed overheads. Under absorption of fixed overheads. $20,000 units at 6.5. Fixed overheads only. $1,30,000. Final figure 10,000. Actually, in your absorption costing statement, this is called as net profit. And the last figure is called as adjusted net profit. This figure is called as adjusted net profit, 10,000. Okay, now let us come to the last part of the question. They said also state whether Vimal Fabrics should accept the special order from the hotel or not. So special order from the hotel is of 10,000 units. Should we accept that or not? Answer is yes, because that results in additional contribution of 3.5 per unit. That comes to around 35,000. So that will increase the profit also. Therefore, it is advisable for the company to accept the special order for 10,000 napkins. Right. Right. Conclusion. By accepting the special order, there is additional contribution of 3.5 per unit. 3.5 per unit. This increases the profit. By rupees 35,000. Therefore, special order from the hotel should be accepted. Any difficulties? Any question that you want to ask? Okay. Let us come to question number 21. This type of question has been asked many times in the examination. So important type of question. Furniture Limited manufactures 3 products: tables, chairs, and cabinets. The company is in the process of finalizing the plans for the coming year. Hence, the executives thought that it would be prudent to have a look at the product-wise performance during the current year. The following information is furnished. You have direct materials, direct labor, factory overheads, then variable and fixed overheads. Cost of production is given. Selling, distribution, and administration expenses, variable and fixed is given. Per unit cost is given. Unit profit or loss is given. And then sales volume is given. Multiplied by the unit profit or loss, you get your total profit or loss for tables, chairs, and cabinets. For the coming period, the selling price and the cost of the 3 products are expected to remain unchanged. There will be an increase in the sales of tables by 1,000 units. So from 10,000, we are going to manufacture an additional 1,000 units, so 11,000. And the increase in sales of cabinets is expected to be 8,000 units. 15,000 plus 8,000, 23,000. The sale of chairs will remain unchanged. Sufficient additional capacity exists to enable the increased demand to be met without incurring additional fixed cost. That is important. Sufficient additional capacity is there. So we can produce more without increasing the fixed cost. Some among the executives contend that it will be unwise to go for additional production and sale of cabinets since it is already making losses of 80 paise per unit. So cabinet, you can see that it is already making a loss of 80 paise per unit. The suggestion is that cabinets should be eliminated altogether. So you have to give your opinion as to whether it should be done or not. So first what we'll do is, we'll calculate the overall profit of the company. Okay, that is 80 plus 60, 140 minus 12, that is 1,28,000. We'll show the working of that under margin costing system, that is a statement of marginal cost. Then we'll show additional sales income that is going to arise from the sale of additional 8,000 units of cabinets and tables 1,000 units. Okay, and then we will see whether we have to cancel the entire production of cabinets or we have to continue. And if so, why? If cancel, then why? If not to cancel, then why? Okay, so let us see. First, we'll prepare marginal cost statement. Tables, chairs, cabinets, total. Okay. So for this, first I'll start with the quantity. Quantity is 10, 15,000, 10,000, 15,000, and 15,000 as of now, without taking into consideration the additional sales that we are likely to take place. We are doing the existing marginal cost statement. Selling price per unit. Why we are doing this? Because we have to see the contribution per unit. We know the profit, but we have to calculate the contribution per unit. Because if I have to take a decision on the additional sale of tables and cabinets, I have to see whether there is contribution. I told you profit is irrelevant in margin costing. Profit is irrelevant in margin costing. What is relevant is the contribution. If a particular product is resulting in contribution, I will manufacture it. If it does not result in contribution, then I will stop, irrespective of whether that particular product is giving profit or loss. Because when I see overall, if there is a contribution, it adds to my profit. And it will be helping me to cover the fixed cost. Okay. Selling price 80, 60, and 36. It is 60 and 36. Minus variable cost, less variable cost. Take only the variable cost. Direct materials 28, direct labor 20, 40. Variable factory overheads 48, variable selling overheads 4, 52. And one more is there. How much is it? 28 and 28 and 20 is 48. 48 and 8 is 56. 56 and 4 is 60. Just check. Chairs, it is 24 plus 12. Materials plus labor, 36. 36 plus variable factory overhead, 6. 42. 42 plus 2, 44. And for cabinets, 16 and 12, 28. 28 plus 4 of factory, 32. Plus 2 of selling, 34. So contribution per unit. ₹20, 16 rupees, and 2 rupees. Total contribution multiplied to the number of units. 20 into 10,000 is 2 lakhs. 16 into 15,000, 16 into 15, 240. And 2 into 15, 30,000. Total of this, 440, 470. Less the fixed cost. Fixed cost I will take total. Tables at the rate of 12. 12 into 10,000, it is 1,20,000. Chairs at 12 rupees. 12 into 15, 1,80,000. and cabinets at 2.8. So 2.8 into 15, 14 and this, okay, 28 and 14, 42,000. Find out the net profit or loss. Two lakh, 3 lakh, 3 lakh 42. 3 lakh 42 means 1 lakh 28. Correct? So net profit is 1 lakh 28,000. That we have got from the table, from the statement that we are given also. But now we have got an idea of the contribution and the total of fixed cost. Now, what I will do is, I'll calculate additional sales arising from 1,000 units of table, that is 1,000 more tables and 8,000 more of cabinets. So write additional income tables. Now income, write in bracket here contribution, because I am concerned with the contribution part. Tables 1,000 units at 20 rupees per unit. Tables contribution is 20 and cabinets are 2 rupees per unit. So this is 20,000. Cabinets 8,000 at 2 rupees. 16,000. So you are having additional contribution of 36,000. You are having additional contribution of 36,000. Okay. Now, how this contribution is going to affect my profit? See, purposely I prepared this margin cost statement. This particular part is not going to change. So this, how much is this? 3,42,000. This is not going to change. This will remain as it is. Okay. So if there is additional contribution of 36,000, additional contribution of 36,000, what will happen? That will add over here. So that means my net profit is 128 plus 36, 164,000. Okay. So by producing additional units, even though final figure is a loss, even though your per unit figure, that what they are pointing out, per unit at the end we are having a loss. That is what they have pointed out here, 0.80. But contribution is coming now. So since the contribution is coming, it will help us to cover up the overall fixed cost. It may not be sufficient to cover up the fixed cost of cabinets, but it will help us to cover up the fixed cost of overall fixed cost of all the three together. It is going to contribute. That is why it is called contribution. It contributes towards covering of fixed cost. Okay, so that will help us to increase the profit by that much more, 36,000. Achha, now they are saying cabinets, suggestion is that cabinets should be eliminated together, altogether. What will happen if cabinets are eliminated altogether? What will happen if cabinets are eliminated altogether? If cabinets are eliminated altogether, this additional, this 30,000 is not going to be earned by the company. So profits will reduce by 30,000. This 1,28,000, this 1,28,000 will reduce by 30,000. So it will become 98,000. If you are deciding to eliminate the cabinets altogether, then the profits will reduce by 30,000. If you are producing additional 1,000 units of tables and 8,000 units of cabinets, the profit will increase by 36,000. Okay, so write down conclusion. From the above, we can state that. From the above, we can state that cabinets is actually contributing. Cabinets is actually contributing rupees 30,000 towards the fixed cost. Rupees 30,000 towards the fixed cost. Therefore, sale of cabinets should continue. Sale of cabinets should continue. If cabinets are discontinued, then profits will reduce by rupees 30,000. Then profits will reduce by rupees 30,000. Next line, right? Additional tables and cabinets. Additional tables and cabinets produced will result in additional contribution. Will result in additional contribution of rupees 36,000. Of rupees 36,000. That is, the net profits will increase by rupees 36,000. Okay. So that completes your question 21. Question number 22. Very small problem, but I want you to solve it first on your own. See if you can do it. If not, then I will show you how to do it. S Limited furnishes the following information. You are given capacity in units 2,000, 3,000, 4,000, 5,000, and 6,000. At different levels of capacity, your unit cost is 40, 35, 34, 32, and 31. Which means that if you are producing 2,000, producing and selling 2,000, you are having a capacity of 2,000 units, then you will have a per unit cost of 40 rupees. As you start producing more, your cost per unit will decrease. Obviously, as you are producing more, the per unit cost will reduce. Why? Because total fixed cost, which remains the same, when divided by more number of units, so per unit fixed cost will come down. So overall cost per unit will come down. And as you are selling more, obviously, since you are selling more, you will be able to sell more when you give a discount. So when you are selling less, you are selling at 100 rupees. 2,000, you are selling at 100 rupees. As you increase to 3,000, you are reducing the selling price, 95 rupees. Or alternatively, when you reduce the selling price from 100 to 95, you are able to sell more. And when you are able to, when you are reducing it further to 94 rupees, then you are able to sell 4,000 rupees. Okay. At present, company is operating at 4,000 units capacity. That means we are selling at 94 rupees and the unit cost is 34. And has received an order for 2,000 units from an export market at 28 rupees per unit. Should the order be accepted? If yes, then why? If no, then why? So calculate and tell me whether the order should be accepted or not. At present, it is operating at 4,000 units. You have received an order for additional 2,000 units. But that additional 2,000 units you are not able to sell at a high price. You will be able to sell only at 28 rupees.
They should accept.
We should accept. Fine. What is the reason why we should accept?
We're getting 6,000 rupees increment in profit.
Yes, we'll get a profit, incremental profit of 6,000 rupees. Whenever you are given these types of questions, that is capacity at different levels, the problem is to be solved by making use of incremental cost and incremental revenue. So we'll have to prepare a statement like this. And this will be called a statement showing incremental cost and incremental revenue. Statement showing incremental cost and revenue. Statement carries marks, because this is the main part of your problem. Quantity in the first column, total cost in the second column, third column incremental cost, fourth column total revenue, and fifth column incremental revenue. Quantity 2,000, 3,000, 4,000, 5,000, and 6,000. Cost 40 into 2,000 is 80,000. 35 into 3, 105, 1,05,000. 34 into 4, 68 and 4 is 136. 32 into 5, 16, 1,60,000. and 31 into 6, 1,86,000. Now incremental cost. First is 80 to 105. 80 to 105 increased by 25,000. 105 to 136 increased by 31,000. Then 136 to 160 increased by 24,000. And 160 to 186 increased by 26,000. Revenue 100 into 2,000 is 2 lakhs. 95 into 3,000, 2,85,000. 94 into 4, 188, 3,76,000. Incremental revenue 2 lakhs here, 85,000 here, 91,000 here. Okay, so the question is asking us that if I'm operating at this level, this is the level at which I'm operating, 4,000 units, where my total cost is 136 and my total revenue is 376. So as of now, at 4,000 units capacity, my profit is 2,40,000. 376 minus 1,36,000. 2,40,000. That is my current profit. If I'm asked to produce more, additional 2,000 units, that means 4,000 plus 2,000. I will come down to 6,000 units. Come down to this level. So what will be the additional cost that I will incur? The additional cost that I will incur is 50,000. Okay? Additional cost that I will incur is 50,000. For how many units? For 2,000 units. Okay? So additional cost is 50,000 for 2,000 units. That means I will be incurring something like 25 rupees per unit as additional cost. So I should recover from the customer at least 25 rupees so that my additional cost is recovered. I should recover from the export trade or export market at least 25 rupees per unit so that I can cover my incremental cost of 50,000. But what is my offer price? Offer price is 28 rupees now. So definitely I can accept the export order because it will give me 3 rupees more than my cost. 3 into 2,000, that is 6,000 rupees additional revenue will be there, additional profit will be there. Okay, so below the table you write. Below the table you write. At present, company is producing and selling. At present, company is producing and selling 4,000 units. 4,000 units. And earning a profit of rupees 2,40,000. And earning a profit of rupees 2,40,000. Full stop. Bracket you write 3,76,000 minus 1,36,000. 376 minus 136. Next line you write. Company has received an order. Company has received an export order for 2,000 units. Company has received an export order for 2,000 units. full stop. If it accepts the export order, if it accepts the export order, it will be producing 6,000 units. It will be producing 6,000 units. Full stop. The incremental cost incurred to produce the additional 2,000 units, to produce the additional 2,000 units will be rupees 50,000, will be rupees 50,000. In bracket you write 24,000 plus 26,000. 24,000 plus 26,000. Therefore, minimum selling price to recover, minimum selling price to recover incremental cost equals to 50,000 divided by 2,000. 50,000 divided by 2,000. That is 25 rupees per unit. Offer price in the export market. Offer price in the export market is rupees 28 per unit. Is rupees 28 per unit. Since the offer price is more than, the minimum expected selling price, the minimum expected selling price, the company should accept the export order. The company should accept the export order since it will increase the profit. Since it will increase the profit by rupees 6,000. By rupees 6,000. Show this working. 28 minus 25 multiplied by 2,000 units. 28 minus 25 multiplied by 2,000 units. So always remember, whenever you are having different levels given or different capacities given, always make use of incremental cost, incremental revenue, wherever possible. Okay. We'll stop you for today. Today evening there is no lecture, but tomorrow again you are having two sessions, one in the morning 10 o'clock and one in the evening again at 6:30. So today evening there is no lecture. Tomorrow two sessions, morning 10 and evening 6:30. Again Saturday I may take two sessions, morning and evening. Okay. So today you take a break in the evening. Tomorrow and day after you will be having two sessions each day. Have a nice day. Keep solving your problems. CA exams have been fixed at 5th of July. So that means more or less your exams will be also confirmed in the month of July. So see that you continue practicing, continue studying. Don't take breaks now because now the situation is improving a little bit. Cases are coming down. Though there are other problems also that we are facing. But mostly I think July will be possible to hold the exams. Prepare for July. Don't wait for it to get postponed. Okay? Have a nice day. Keep practicing. Keep safe.
Thank you.